20% of the world's daily oil supply stopped moving on March 4, 2026. Not slowed, not reduced, stopped. Iran's Islamic Revolutionary Guard Corps declared the Strait of Hormuz closed to vessels from the United States, Israel, and their Western allies, and then it began backing that declaration up with action, striking tankers with drones, planting naval mines, and forcing over 150 oil tankers to drop anchor in open Gulf waters rather than attempt the transit. The International Energy Agency called it, in its own published statement, the largest supply disruption in the history of the global oil market. Brent crude surged above $100 a barrel, and gold, which was already trading near $5,000 an ounce before a single missile had been fired, moved to its own records in the days that followed. Here is what this video is going to prove. First, the gold price you are seeing right now is not a panic spike. It is the surface expression of a structural repricing that was years in the making. And the Iran war has simply accelerated an institutional realignment that central banks and major banks already had in motion. Second, silver at $85 an ounce is not simply following gold higher. It is sitting on top of a physical supply crisis that is unlike anything the COMEX has measured in its modern history, with registered deliverable inventory down more than 80% from its 2021 peak, and lease rates in London that spiked to 8% in January, when the normal reading is under 0.5%. Third, the historical parallel that matters most here is not 2022, and it is not 2020. It is 1973, and understanding exactly what that parallel holds and where it breaks down is the most useful analytical frame you can carry into the next several weeks. Stay with me, because by the end of this video, you will understand why the data suggests that what is happening in these markets right now is not noise. Let us start with the facts as they stand on March 13, 2026. Gold spot was trading at approximately $5,110 per ounce on March 12th, according to USA Gold's published daily price history. Earlier in the same week, on March 10th, Fortune's daily gold price update recorded the metal at $5,195 at 9 in the morning Eastern Time. The intraday high for the current cycle reached $5,417 on March 3rd, reported across multiple Indian market publications, citing global spot benchmarks, as safe haven flows accelerated with Middle East tensions. Year over year, that represents a gain of approximately $2,280 per ounce in 12 months, a figure Fortune explicitly cited in its March 10th update. For context, gold was below $3,000 per ounce in early 2025. The move to $5,000 and beyond occurred in a single calendar year, driven initially by central bank demand, persistent above-target inflation across major economies, and dollar weakness, and then turbocharged by the joint U.S.-Israel strikes on Iran that began on February 28th. On the silver side, JM Bullion's live price tracker recorded the silver spot price at $85.16 per ounce at 10:59 p.m. Eastern Time on March 12th. That is a number that requires historical context to land properly. In January 2025, silver was trading at approximately $31 per ounce. In just over 12 months, it has gained nearly 180%. According to the CME Group's published analysis of precious metals' relative value in early 2026, silver had posted gains of 170% from the end of 2024 to early January, performance that placed it ahead of every other major asset class. J.P. Morgan Global Research's published silver price commentary, attributed to metals research head Greg Shearer, projects silver averaging $81 per ounce across 2026, a figure the metal has already exceeded. Shearer noted in that published research that roughly 60% of annual silver demand flows into industrial applications, a structural reality that gives silver a demand floor that gold does not possess, because silver is not just being held, it is being consumed. Now here is the tension that sits at the heart of this story. The paper price of silver at $85 represents what the futures markets say the metal is worth. What physical buyers are actually facing is a different picture. COMEX registered inventory, the silver officially available to deliver against futures contracts, stood at approximately 70 to 80 million ounces in early March 2026, according to tracking published by goldsilver.ai, citing COMEX warehouse reports. The paper coverage ratio, the proportion of outstanding futures contracts that deliverable metal could theoretically satisfy, sat at 13.6%. 13.6. Below 15% is defined as stress territory, and the paper leverage, the ratio of outstanding paper claims to deliverable metal, stood at 7.4 times. Meanwhile, according to an analysis published at Trading Key in January 2026, by early March the London silver lease rate remained in the range of 7 to 8%, compared to a normal reading of 0.3 to 0.5%. That is a 16 to 27 times elevation in the cost of borrowing silver. The LBMA's own published 2026 analyst survey noted, in published commentary by one of its participating analysts, that silver's lease rate remains at a much higher level than gold, and that the market's liquidity problem is getting larger. I want to address the most obvious counter-argument here because it is a fair one, and it deserves a direct answer. The counter-argument is this. Silver hit $121 in late January 2026, crashed nearly 47% to below $64 in the first week of February, and has now recovered to $85. That crash happened. It was real. And the natural reading is that silver is wildly speculative, prone to violent reversals, and the $85 level is just a temporary bounce before the next leg down. This is a legitimate concern. But look at what actually caused the January crash. According to analysis published by the finance magnate's financial news platform on March 10th, and corroborated by multiple market commentaries, the January crash was driven by a CME margin hike, the exchange raising the amount of capital futures traders were required to post against their positions, which forced highly leveraged speculative longs to liquidate rapidly. That is a mechanical event, not a fundamental one. The key question is whether the margin hike and the resulting liquidation changed any of the underlying supply and demand parameters. According to COMEX warehouse data reviewed across multiple published sources, COMEX registered inventory continued declining after the crash. The Silver Institute confirmed the sixth consecutive annual supply deficit for 2026, with industrial demand consuming approximately 59% of total supply. China's export licensing restrictions on silver, operational since January 1, 2026, remained in force. None of the structural variables changed. The crash cleared out leverage. It did not clear out the deficit. Now for the section that separates what you will hear on this channel from what most financial media is reporting. The detail that almost nobody is connecting to the Iran story involves not oil and not gold, but the specific geography of silver supply and China's role in it. Since January 1, 2026, China has imposed export licensing restrictions on silver, reclassifying it as a strategic material. This was documented in the Trading Key analysis published in January and is consistent with broader reporting on China's critical mineral policy. The practical effect is this. China had been one of the largest sources of refined silver flowing into global markets. By restricting exports, China has effectively fragmented what was already a stressed market into three regional pools: Asia, centered on Shanghai; North America, centered on COMEX; and Europe, centered on the LBMA in London. Each region is now competing for whatever physical metal it controls. And here is the Iran connection that very few analysts are making explicit. The Strait of Hormuz crisis has now imposed an additional supply chain fracture on top of this already fragmented silver market. Mining operations across the Gulf region and the broader Middle East, along with Indian silver import logistics which rely on Persian Gulf shipping routes, are facing elevated insurance costs and transit disruption. According to the Congressional Research Service report published on the Iran conflict and the Strait of Hormuz, the UK Maritime Trade Operations Centre had recorded more than a dozen attacks on ships in and around the strait as of early March. Ship insurance war risk premiums for strait transit had already risen from 0.125% to between 0.2 and 0.4% of ship insurance value per transit before the conflict began. The disruption to regional shipping routes matters for silver because India is one of the world's largest silver importing nations, and supply route disruptions add cost and delay to a market that was already under structural strain. Here is what nobody is putting together in a single analytical frame. You have a sixth consecutive annual silver supply deficit, registered COMEX inventory down over 80% from its 2021 peak, London lease rates at 14 to 16 times their historical norm, Chinese export restrictions fragmenting global physical supply, and now a military conflict that is disrupting the regional shipping arteries that serve one of the world's largest silver import markets. These are not separate stories. They are reinforcing fractures in the same physical supply chain, arriving simultaneously. The historical parallel that deserves careful examination here is the 1973 oil embargo, not because the situations are identical, but because the structural mechanism is directly analogous. In October 1973, as documented by the Federal Reserve's own published history of the event, Arab OPEC members placed an embargo on oil exports to the United States and other nations supporting Israel in the Yom Kippur War. The price of oil quadrupled from approximately $3 a barrel to nearly $12 a barrel in the span of months. Gold, which had only recently been freed from its Bretton Woods peg of $35 an ounce after Nixon closed the gold window in 1971, began its long ascent toward $455 an ounce by the end of the decade. The mechanism was the same one operating today. A Middle East military conflict disrupts physical commodity supply. The disruption combines with pre-existing monetary inflation and dollar weakness. Hard assets, particularly gold, function as the reserve of last resort for capital fleeing fiat currency exposure. Here is where the parallel holds in 2026. The United States is again in direct military involvement in a Middle East conflict. Oil prices have surged dramatically. Brent crude climbed from $70 a barrel before the war to above $97 within 2 weeks, according to CFR's Global Conflict Tracker citing BBC price data. The IMF's published statement, cited by the same tracker, warned that every 10% increase in energy prices across 2026 is expected to lift global inflation by almost half a percentage point. Inflation was already above central bank targets in most major economies before the first strike was ordered. And central banks had already been buying gold for 3 consecutive years at above 1,000 tons annually, according to JP Morgan's published 2026 gold research. Here is where the parallel breaks. In 1973, the United States was a large net importer of oil, profoundly vulnerable to supply disruption. In 2026, the United States is the world's largest oil producer. Energy Secretary Chris Wright told CNBC on March 12 that the U.S. views this as short-term pain for long-term gain. That is a fundamentally different structural position than Nixon's America in 1973. The parallel is useful for understanding the precious metals response mechanism, but it does not map perfectly onto energy markets. The second historical frame worth examining is the 1979 Iranian Revolution's effect on oil and gold. When the revolution disrupted Iranian oil output, gold rose from around $250 an ounce in early 1979 to $850 at its January 1980 peak, a more than threefold move in under a year. The structural driver was, again, the combination of physical supply disruption with pre-existing monetary inflation. The Bank of England, through its published Monetary Policy Committee communications, has been navigating an environment where UK inflation has remained stubborn, and where the LBMA, the institution which sets the global benchmark gold price twice daily through its ICE-administered electronic auction, has seen gold priced in sterling reach record levels above £4,000 per troy ounce. British institutional exposure to the current gold move is not marginal. London's vaults hold approximately 8,000 tons of gold, and British investors with direct positions in sterling gold have experienced compound gains that are distinct from the dollar-denominated headlines. Now, here are 3 specific, datable events to watch in the coming 48 to 72 hours, and precisely what to look for in each one. The CME Group publishes its COMEX warehouse report each trading day, typically visible to subscribers by late afternoon Eastern Time. The specific figure to watch in that report is registered silver inventory. If it continues its decline below the current level of approximately 70 to 80 million ounces, with the paper coverage ratio remaining below the 15% stress threshold, that data point validates the physical supply thesis and suggests physical premium pressure will remain elevated. A reversal, meaning a significant inflow of metal into registered categories, would challenge the thesis and is worth noting honestly. The second event is the U.S. Central Command briefing cadence, which has been publishing updates on Strait of Hormuz operations daily. The specific development to watch is whether the Navy begins escorting commercial vessels through the strait. Treasury Secretary Scott Bessent told Sky News on March 12 that the Navy would do so as soon as militarily possible. But Energy Secretary Chris Wright told CNBC the same day that we are simply not ready. If escort operations begin, shipping insurance premiums will begin falling. Some tankers will restart transit, and oil's upward pressure on inflation expectations will ease, which would moderate some of gold's war premium component. If escort operations are delayed, oil above $100 becomes more entrenched, and gold's inflation hedge bid strengthens. The third item is the weekly Commitment of Traders report, published each Friday by the CFTC. According to analysis from TradingView's published COMEX silver research, managed money, hedge funds, and commodity trading advisors held a net long position of only 5,472 contracts in the February 17th report, a fraction of the positioning seen during silver's run to $121. If the next COT report shows a meaningful increase in managed money net long positioning, it indicates that institutional participants are re-entering the silver market above the post-crash recovery, which would validate the case for a second leg higher with fresh, rather than recycled capital behind it. To summarize the central findings of this video in plain language, gold is trading above $5,000 per ounce because three reinforcing forces: central bank structural buying at nearly 800 tons per year, according to JP Morgan's published research; persistent global inflation, now intensified by an oil supply shock; and direct military conflict disrupting the world's most critical energy choke point, have converged simultaneously for the first time in the modern gold market's history. Silver at $85 is not simply tracking gold higher. It is sitting on documented physical supply stress, registered COMEX inventory down more than 80% from its 2021 peak, a paper leverage ratio of 7.4 times, and London lease rates that spiked to 8% in January against a historical norm of 0.3 to 0.5%. China's export restrictions on silver, in force since January 1st, have fragmented global physical supply into three competing regional pools, removing a key pressure relief valve. The Iran war's disruption of Persian Gulf shipping routes adds an additional layer of supply chain stress to a market that was already structurally constrained before the first airstrike. The historical precedent of 1973 and 1979 suggests that when Middle East military conflict combines with pre-existing monetary inflation and dollar weakness, hard assets experience multi-year repricing, not single-event spikes. The specific question that the data cannot yet answer, and that I would genuinely like to hear your thinking on in the comments, is this. Given that silver has now lived through two violent $60+ swings in a single quarter, at what point does the extreme volatility itself become the argument against it as a store of value, rather than an argument for it? That is a harder question than it looks, and I do not think the answer is obvious. Thank you for watching. This video is for educational purposes only and does not constitute financial advice. Every figure cited in this video comes from a named public source: COMEX warehouse reports, JP Morgan Global Research, the LBMA, the CME Group's published analysis, the Congressional Research Service, Al Jazeera, CNBC, the Federal Reserve's published history, and others, all linked in the description below. Verify every figure independently before making any financial decision.